If you factor in a lifetime of housing, healthcare, raising a family, and retiring, living the standard American dream today costs nearly $3.4 million. For younger generations trying to build a foundation on stagnant wages, that price tag feels like an impossibly heavy weight. But there is a massive wave of liquidity on the horizon. This chart illustrates what economists call the Great Wealth Transfer. By 2045, an estimated $84 trillion is set to change hands, cascading down from older generations to their heirs. The baby boomer generation alone currently controls roughly $78 trillion of that pie. And while that sounds like a massive influx of cash ready to hit younger bank accounts, the reality of where that money actually sits is much more complicated. Most of that wealth isn't sitting in liquid checking accounts. It is heavily trapped in decades-old stock portfolios and vast amounts of residential real estate. The popular assumption is that as this $84 trillion trickles down, it will act as a massive economic reset, a financial bailout that will finally allow the struggling middle class to afford a home and start families. But assuming this transfer will democratize the economy ignores the mathematical reality of who actually holds the assets. Understanding the true trajectory of this money is the only way to navigate the economic shift that is about to happen. When we hear that $84 trillion is being passed down, we fall victim to the illusion of averages. We picture a rising tide that lifts everyone's boats equally. Looking at this distribution chart, you can see the problem. The top 10% of the U.S. population already owns more than half of all national wealth. The bottom 50% holds almost none of it. And when we look closely at the incoming wealth transfer, the concentration becomes extreme. A tiny 1.5% of ultra-high net worth households are positioned to receive 42% of all the capital moving to the next generation. This concentration happens because the U.S. tax code is built with specific mechanisms protecting generational wealth. When assets are passed down, they benefit from a step up in cost basis, which wipes out the capital gains taxes on a lifetime of growth. Combine that with federal estate tax exemptions, and a wealthy family can legally transfer up to $26 million to their heirs without paying a single cent in federal estate taxes. This chart scales the math of those loopholes. Over the next 2 decades, the wealthiest Americans are set to inherit roughly $30 trillion. On that massive sum, they are estimated to pay only $4.2 trillion in taxes. With $30 trillion moving through these specific tax-advantaged channels, the transfer functions as a filter, concentrating existing capital into a smaller number of hands. But even if the majority of the wealth stays at the top, the transfer process itself will cause ripples through the market. When heirs receive an inheritance, they rarely keep the exact portfolio their parents built. Instead, they sell. This triggers a process we can call generational liquidation. The incoming generation will aggressively cash out of assets they don't understand, don't want to manage, or simply view as obsolete. Physical stores of value are the first casualties. Younger investors inheriting hard-to-store assets like gold bars are highly likely to liquidate them for digital alternatives. The same is true for fixed-income government debt. A portfolio heavy in legacy U.S. savings bonds or low-yield treasuries will be quickly dumped by younger heirs looking to chase higher returns. Even traditional blue-chip stock portfolios face the threat of liquidation. Heirs will sell off reliable, slow-growth equities to fund new lifestyle demands, pay off high-interest debt, or seek out different investment vehicles. This generational handoff is creating a massive friction point. Trillions in legacy assets are being systematically exchanged for new stores of value, shifting the gravitational center of the market. When you liquidate trillions of dollars in real estate, bonds, and equities, that capital doesn't just sit in a checking account, losing purchasing power to inflation. It has to go somewhere. This creates a capital rotation. The wealth is migrating from boomer-era legacy investments into millennial-era assets. A major target for this freshly mobile wealth is alternative assets. Ultra-high net worth individuals are funneling cash into high-end contemporary art because it offers growth that operates independently of stock market volatility. And the world's largest institutional asset managers know exactly what is happening. Firms like BlackRock and Goldman Sachs are actively advising their clients to dedicate up to 20% of their portfolios to these exact alternative investments. Digital scarcity assets are also positioned to absorb trillions in capital. As younger generations inherit, they are redefining what a store of value actually is, moving capital out of physical gold and pouring it directly into decentralized networks like Bitcoin. For an individual investor, these institutional rotations provide a clear roadmap. Identifying the assets currently absorbing this generational wealth offers a way to move alongside the largest blocks of capital in the market. The Great Wealth Transfer ensures that systemic inequality is locked in for decades to come. But strategically rotating your personal capital into the exact assets the ultra-wealthy are buying right now is your strongest defense against an economy that is steadily leaving the middle class behind.